Hey everyone, Matt Stevenson, President of Allied Wealth here. Thanks for joining us for more content today. If you like today's content, remember to hit the like button below and subscribe to our YouTube channel for more videos to come. What I wanted to talk with you about today are some of the client questions and concerns that we're getting in the office given today's market environment and how volatile things are. And a big part of that conversation revolves around understanding how we're positioned with the portfolio compared to all the uncertainty out there and perhaps some adjustments to be made in today's environment. The first step towards understanding where we sit comes with identifying our benchmark. And a benchmark is simply a comparison of our set of investments to some mix of stocks and bonds out there. And we can identify our benchmark on a risk versus return scale. And that scale goes from bottom left to top right. For instance, the bubbles on the bottom left would be more conservative. As we get to the top right, these would be the most aggressive set of investments. They should get the highest amount of return over time, but they will likely be the most on the emotional and monetary roller coaster. The more conservative side of the portfolio gives us more stability over time. Now we can also use this scale to identify our benchmark or comparison. And that'll be one of the key notes for today's chat in how to properly position with this uncertainty. For instance, if we are more aggressive, and let's say that we're on this top right bubble out here, our direct comparison or benchmark would be 100% stocks, or simply the S&P 500. Okay. Traditionally speaking, as we look to reduce risk inside of the portfolio, we would add bonds into that mix. For instance, as we scoot down this scale one notch, that benchmark would be an 80-20 benchmark. The 80% here represents the amount of stocks or equities in the portfolio. The 20% represents the proportion of bonds or fixed income in the portfolio. Now, many of you may have heard the term a 60-40 portfolio. That's one more notch lower. And this is where a lot of folks that come to see us fall on this scale. Again, the top number representing the proportion of stocks, the bottom, the proportion of bonds in your portfolio. Now, this is also one of the key things that we talk about in our client visits each quarter or each 6 months. And the reason why is we have to understand our comparison as opposed to what we see on the news. Because when we look at things like CNBC or the nightly news, the first thing that we hear related to the stock market is, well, how did the S&P do that day? Or the Dow Jones, up, down, or sideways? And naturally, we're going to translate how the market did in a given day to how our nest egg does each day as well. And oftentimes, that's not simply the case, because many of our clients, many of you out there, are more conservatively positioned than simply the stock market, which is here on the far right. Now, when we begin to dive deeper into understanding our benchmark, that leads more into a conversation about how to position given all the market volatility. And this is one of those rare instances in 2022 where we have both the equities market sliding due to both inflation, interest rates, all these domestic concerns, but also the geopolitical events that we're seeing overseas. All these different variables leading to the stock market in decline a bit here this year, but we're also seeing the bond market decline at the same time. And this is an interesting conversation because for the first time in 40 years, we're seeing interest rates go up. Now, you may be thinking to yourself, how do interest rate movements affect the bond portion of my portfolio? The fact is, it directly impacts the bonds. So, for instance, we have to consider that bonds have an inverse relationship to interest rates. So, it's been great to be a bond investor for nearly 4 decades now. If we think back to the early 80s, many of you may have had your first home purchased in the early 80s. We may have purchased a bank CD at that time, and the average interest rate on those products was somewhere between 10 to 15%. Now, over the subsequent decades, we've seen those rates steadily decline to where by the time we reached the beginning of the pandemic in 2020, we quite literally hit the floor on the interest rate environment at 0. And now, because of all of the stimulus, all these other variables, we have the highest levels of inflation we've seen in that same time frame, nearly 40 years, 8.5% year over year as of right now. And so in order to combat that, we know that interest rates are on the rise. And so as we begin to see interest rates climb, it's really the direct opposite effect of the bond market that we've seen over the past 40 years, where in that falling rate environment, bond values went up. It's an inverse relationship. But now, as we're beginning to see already this year, as rates creep upward, bond values, especially in the short term, fall in value. And so this is really a conversation to be had about positioning yourself for that bottom number that we're talking about in relation to our benchmark, because moving forward, we feel strongly that interest rates will continue to rise given all the headwinds that we're facing. And so being able to position outside of an asset class such as bonds that may be declining in value for some time is very important. And that ties directly to taking a tactical approach to how we invest. And so for a reminder, for those of you at home, when we build a tactical approach to allocating your dollars in your financial plan, we look not just at things such as the stock market or the bond market, but we also have the ability to allocate to things such as real estate or perhaps commodities. A good example would be oil and gas or gold, international investments, and even currency or cash. And this approach is founded on 2 fundamental points. The ability to allocate dollars at any given time across these different categories is essential to creating an environment to where you can remain successful no matter what the economy, interest rates, or the stock market is doing around us. But most importantly, it's the ability to adapt to our market and economic surroundings. Because what we see every single day across the globe is that money flows in and out of these different categories, much like water would inside of a bucket. And so being able to adapt given the market conditions we're facing, utilizing different categories of assets at any given time allows us to weather the storm and navigate uncertain environments such as this. However, there's one other key piece to this discussion, and it ties directly to the bond market. So if we think about our benchmark, and for many of you at home, you may fall in that middle category of the 60-40 portfolio. Again, that's worked extremely well for many decades. However, moving forward in a rising rate environment, one of the things that we're having conversations around with our clients is the ability to shift risk away of owning individual bonds or bond funds that may decline in value for a while, and being able to protect that portion of the nest egg while getting a similar, if not better, return. And so this is where out-of-the-market investing can come into play, where we're still seeking a good rate of return of somewhere between 4 to 7% over the lifetime of that investment. We have the ability to access our dollars within these programs, but also being able to protect a portion of the nest egg from all of the uncertainties that are surrounding our current climate. It's really about finding that balance between how do we allocate dollars tactically given the market conditions, and what are some ways that we can add safety into the portfolio and prepare ourselves for a future rising rate environment in the bond market. So that's what I wanted to share with you guys today. I hope you enjoyed our content. Remember to hit the like button below and subscribe to our page for more content to follow.